A cash flow statement, also known as a statement of cash flows, is a financial statement that shows the inflow and outflow of cash and cash equivalents for a specific period of time, typically a quarter or a year. The cash flow statement is one of the three financial statements that companies are required to disclose, along with the income statement and the balance sheet. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. The operating activities section shows the cash generated or used by the company's main operations, such as sales and expenses. The investing activities section shows the cash used for investing in long-term assets, such as property, plant, and equipment, or investments in other companies. The financing activities section shows the cash used for financing activities, such as issuing or repurchasing stocks, issuing or repaying debt, or paying dividends. The cash flow statement is important to investors for several reasons. First, it provides a clear picture of a company's cash position, which is critical for assessing its liquidity and ability to meet its financial obligations. A company that generates positive cash flow from its operations is more likely to be able to pay its bills and invest in growth opportunities than a company that is constantly running a cash deficit. Second, the cash flow statement helps investors assess the quality of a company's earnings. Some companies may be able to artificially inflate their profits by using accounting tricks, such as deferring expenses or recognizing revenue early. The cash flow statement, however, is less susceptible to such manipulation, as it focuses on the actual cash generated by a company's operations. Third, the cash flow statement helps investors evaluate a company's ability to generate free cash flow, which is the cash that a company has left over after paying for its operating expenses, capital expenditures, and debt service. Free cash flow is important because it can be used to pay dividends, buy back stock, make acquisitions, or invest in new projects. A company that generates a lot of free cash flow is generally considered to be in a strong financial position. Fourth, the cash flow statement can also help investors assess the sustainability of a company's dividend payments. Dividends are payments made to shareholders out of a company's profits. A company that consistently generates positive cash flow from its operations is more likely to be able to sustain its dividend payments over time. Fifth, the cash flow statement can also provide insight into a company's capital expenditure plans. Capital expenditure is the money a company spends on long-term assets such as buildings, equipment, or land. A company that is investing a lot in capital expenditure may be planning for future growth, while a company that is reducing its capital expenditure may be indicating a lack of confidence in its future prospects. In conclusion, the cash flow statement is an important financial statement for investors because it provides a clear picture of a company's cash position, helps assess the quality of a company's earnings, evaluates a company's ability to generate free cash flow, assesses the sustainability of a company's dividend payments, and provides insight into a company's capital expenditure plans. It is an essential tool for investors to understand a company's financial health and make informed investment decisions. Use code BLOG to receive 25% on your next purchase.